Hi there, I'm Brad Gilbert, the founder and CEO of Traders for Traders. Now, I'm constantly getting messages from our YouTube clients about how to trade. What's the technical setup? Why does that economic data influence the market so much? Right? A range of questions around trading. So, you know what? To answer these questions, I'm going to produce a beginner series focusing on the 4 key aspects of trading. Now, the beginner series is going to set you up to become a successful trader. You're going to have clear understanding of the 4 key components that I'll be covering through this series, starting with technical analysis and then moving into the fundamental analysis, which is the economic data, and then moving into capital management, probably the most important aspect. And last but not least, trade execution. Now we're going to do a deep dive into each component. So you have the foundation components for a trading system. So you have the foundation components for your trading system. That is going to set you up for the best starting point for your trading. This is really going to open your eyes to how the bankers trade the markets. And this is really going to give you some insight into how the bankers analyze the markets, manage their cash, and execute those trading opportunities. All right, without further ado, let's start with technical analysis. Now, technical analysis is probably the most misinterpreted aspect of the market. It's completely subjective, and a lot of traders get caught up with adding too many indicators to their charts, trying to work out where that next trading opportunity is. But as I go through this section, you'll find that the banker's process is extremely simplistic. And why does it work? Well, it goes a long way back to how the bankers were trained. When I started at Citibank in 1990, technical analysis was all about the scrolls, right? Big 20-meter scrolls of charting paper that we had one analyst, he'd be on the floor, drawing lines, trying to connect the dots to the next major level, right? It was hardcore. And then as the computer systems got better, technical analysis went online. And how the bankers learn this? Well, I was a graduate, right, at Citibank. And there was about 50 or 60 graduates across all the various banks. Now, we had a technical analyst come down from New York and basically give us a whole week of training. All of us, all from different banks, doing the exact same thing. And then these traders over time go back through, and that knowledge is filtered down through the graduate program. This is why all the bankers do their analysis the same way. Now, that doesn't mean some individuals use different strategies or techniques. Of course they do, right? If you can improve your probability by including a specific indicator, then that's a good thing, right? And I would never discourage that. But the main thing is to understand the way the bankers do their analysis is universally the same across all institutions. All right, now I'm going to start with trend lines, and then we're going to move into trends and then gauging momentum in the market. Now, this is going to take a little bit of time. So get yourself comfortable, maybe grab a coffee, sit back and relax as I take you through technical analysis for beginners. Okay, to kick things off, let's just deep dive into what is technical analysis and why does it work? Okay, well, technical analysis is an analysis methodology that predicts future price movements of past price data. It's as simple as that. And why does it work? Well, as I mentioned earlier, all the bankers are trained to analyze the market technically the exact same way. Now, these guys control 95% of the volume. If they're all doing their analysis the same way, well, when a market breaks or holds a support level, they all do the exact same thing. And that's when you see the big momentum shifts in the market. Now, once you understand that, it's just a matter of understanding all the different components, trend lines, trends, how to gauge momentum. We'll look at the Ichimoku cloud and how to overlay other instruments on your charts. Okay, now let's just start with what constitutes a trend line. Now, a good trend line will have 3 price touches. Okay, that sort of basically validates the trend line. And it means everyone at every institution will be probably looking at the same instrument, right? So let me just show you an example, okay? Looking at resistance. So I draw my trend line from the starting point to the next starting point, okay? So you got 1 touch here, 2 touches, right? And this is how the trend line develops. It comes back and you can see it actually holds there at that first level initially for a couple of hours. That's our 3rd touch, right? From this point on, the trend line is valid. But once the trend line breaks, if there's price action above the trend line, we need to adjust the trend line accordingly. Okay. And this is how trend lines evolve and develop. So let me just clear the screen. Once we've got that third touch and we've got the new high, you're redrawing the trend line to the next valid point. Now, what that means is we've got our starting point and our previous initial point, which is our second point, and now we've got a third touch. Okay, so disregard this part of the analysis at this point. You can see from this point on, okay, every time it gets close to the resistance trend line, the market is selling, right? Those three touches validates the trend line and it is in play. Why is that important? For resistance trend lines, okay, if you've got a resistance trend line in play and it's got three touches, well, more often than not, the market will start selling as it gets close to those trend lines. And you can see how that occurred on those 2 points. And then it started to happen again when it got back to the trend line. Now, depending on market conditions and momentum, you are going to get flush outs, right? Where the price action has enough momentum to take out the stop losses above the trend line. Okay. From this point, we just start again. Okay. You've got your trend line there with the 2 previous touches. The trend line now moves over to the next highest point. And you can actually start to see exactly where the price action is. This one here, I would say 1, 2. I would validate that as 3. That was a previous high. And then you've got 4, right? Now that's even better. The more touches, the better the trend line. Okay, so from that 4th touch, okay, as it gets close to the trend line, you can see the market is selling. And that continues until once again, there's a bit of a momentum shift and it takes out the stop losses again. Now, the key to this video is just understanding you need 3 touches to constitute a trend line. But I can tell you from my experience working at the banks and in the markets for 35 years, by the time it gets to the 3rd touch, the market is already anticipating the 3rd touch and they get very active. Okay, now that you understand what constitutes or validates a trend line, we need to show you the rule of thumb for drawing the trend lines, right? This is going to make a lot more sense. Okay, so I'm on the hourly chart on Euro. Now, this is the Metastock workspace. It's a platform I've been using for over 20 years. It was previously called Metastock Icon, but is now Metastock Workspace. Okay, so what we need to do when you are starting to draw trend lines, you need to find the high and the low for the relevant time period, right? So what you do is you just slowly scroll back in time, get as much data as you can on the screen. Now, with your hourly charts, you're going to have limited amount of data. When it comes to the daily charts, we can go back 20 or 25 years. And that's where you find the longer term trend lines, right? And that's where we're going to find the long-term trends. But for now, we're trying to find those support and resistance levels on our hourly charts, okay? So as you can see, right, there's a bunch of data here, which is above the low and below the high that we can see on the screen. So I don't need to take into consideration this data. What I need to look at is start drawing support trend lines from this point and resistance trend lines from the top. Okay, that's as simple as it is. So what we do from here, just scroll the data back out and let's just focus on the support trend lines for the time being. Okay, so I come up to draw array. Okay, so I click on the bottom point and I go to the next lowest point. Okay, this is the easiest way to do it. Then you can go 1, 2. Okay, let's just have a look where that trend line goes to. Okay, so it's below the market, right? That's the starting point for our support trend lines, but it's miles away and there are other ones to look for. So once we've identified that, we leave it there and you come back to the next lowest point, right? Which is our second touch where the market started to go up, right? And this is where we start drawing our trend lines from. Okay, if I just widen out the screen a touch, come back, get the line tool, and coming in to draw our analysis. Okay, so now I'm drawing from the starting point. This is my second touch, right? In actual fact, you could probably say this was a second touch. That might be the third. And then you've got like the 4th over here. So it has got quite a few touches, this trend line. This is part of the history of this trend line, that price action. So now when we do come back and look at the price action and where the current market is in relation to this trend line, you can start to see a lot more shape. Okay, so we've got these levels. As I said, that would be 1, probably 2, 3 is the touch, 4 is close enough. And then we've got the current price action. So we've got support trend line 1 down the bottom. We've got support trend line number 2 above that. But let me just remove the drawings. You can see from this point on, it went up again, right? So you need to draw your support trend line again, right? There's no limit to how many support or resistance trend lines you can draw, as long as you can validate them. And that's what we'll do at the end when we've drawn all the support and resistance trend lines. Okay, so let's just widen this out again and going from the low point, this one here, right? And it's going to be one of these 2 points here is our next level. And then we can start to see if there's any price action below that. If there is, then we adjust it to the next level. All right, so let me just do that process. Once again, come up to Ray, get on that level. Okay, so let me just rest on this point here. And then I look across, right, at the price action over here. You can see there's price action below the trend line there. So even though we've got 1, 2, 3 touches here, it's already moved below that. So what I need to do is consider that price action. So what I would do is you come to the next point. You can still see it's there. The price action is still below, and we have the key level there, right? So we've now got the most valid support trend line. You could be going 1, 2, 3, even if you just call that number 4, right? There's 4 touches on this trend line. That constitutes and validates this trend line as the key support level in the market. Now, every trader at every bank will be able to identify that. And that's why you're looking for at least 3 touches, if not 4. And when you're looking at the longer term charts, you may have 5, 6, or 7. The more touches, the better the trend line. And that's going to help us determine what strategy we're going to use when it gets close to those trend lines, right? And this gets closer to us trying to work out where the overall direction is, which we'll find out shortly when we get to trends, when we are looking at the daily trend lines. Okay, so we've got 4 touches on that support trend line. Now, if I just blow up the screen a bit, okay, then you can start to see and give the chart some meaning. We've got a key support level here around 113, the figure on euro. Now, there's a secondary support trend line below that, okay, around 112 sort of 40. And then we've got a longer term support trend line around 108.75. Okay, so we've got 3 support levels on our hourly charts. Now, what you can be doing, and this is something I would suggest, is you come back and analyze the trend lines, right? So if we're just looking at the first one, okay, so you've got 2 touches, right? But it is the only support trend line there. It's a long-term level. Now, what I like to do is color code the various trend lines, right? The one that is most relevant with a lot of touches, I keep as red, right? Now, this second trend line, it's got a couple of touches, okay? But it hasn't got as many as that first one. So if it's not fully validated just at the moment, I'll change that to orange. And that enables me when I come back to the screens to make a split-second decision. I can see the strength of the trend line through my color coding. And this goes for the bottom trend line, which I would sort of call longer term, right? So my long-term trend lines I have as green. The secondary trend lines I have as orange, which generally means maybe they haven't had as many touches and they don't go back as far in the history. And the primary support and resistance trend lines I would have as red. I know they are active in the market and validated, right? So they're our support trend lines. Now, you would do the same for resistance, right? And as we did when we widened out the data, we found these 2 levels, right? Start of our support trend lines and the start of our resistance trend lines. And you do the same process, okay? So let me just widen out the screen. This is a little bit easier because we don't have too much price action from where euro topped out. So if I just draw the trend lines in, okay, so this would be the starting point. Now let me just change that back to red. Now, once again, okay, so we've got the starting point, we've got the second point. We can see price action over here, 3, probably 4, maybe even 5. And this is the life of this trend line, right? If I just show you how it worked, like you've got the first two touches. We're waiting for that third validation. It sort of stalled at that level, but then the market went through that. Okay, so we've got to take that into consideration. And then you get the next high, right? And this is how the trend line would have been until it breaks through up here, right? So that trend line from this point, you would just move it over to the new high. And this process continues until you've got your trend line where there's no price action above the trend line. Okay, so you could potentially be calling that 3, this number 4, and then you would adjust it to this level here, which would be number 5. And what you end up with is a trend line with 5 touches. Okay, now the question now is, when do I move the trend line from that point to the next level, right? The highest point. Okay, well, one simple method that you can use is if the price action drops back down below the resistance trend line, then you can go and draw the trend line again. But you've just got to be careful here. And let me explain why. Let me just widen out the chart somewhat. Okay, the price action around the trend line, we call the barroom brawl, right? And that's where there's just an unknown price action. This is where 95% of volume occurs. Now, when it gets close to resistance trend lines, you find selling below the market. But just above the market, you'll have buy orders. That's where the stop losses are kept, right? And the same on the downside. As it gets close to support, you'll have buying orders, right? And just below that, you'll have the stop losses, right? Which are selling orders. So you've got two different levels here. And the price action. When do we move the trend line to the top? Well, generally speaking, if the price action breaks at least 10 points below the trend line, I would redraw the trend line to the top. Now, in this example, if I get the crosshairs here, I look at the level 113.37, it's gone down to 113.24. Okay, so that's more than 10 points below the level, right? So at that point there, you can simply redraw the trend line to the next relevant high. But don't forget, when we do that, we're starting to lose the connection with the past price history to the trend line. It's actually further away, right? And that level now really, it's from the starting high to the most recent high. So that doesn't have as much strength, right? So what I would do at that point, I would change the trend line to orange. So I know that's the resistance level, but it doesn't have that much weight, right? So next time it goes through there, it may move back through quicker. And I need to know that because if I'm putting on a strategy looking to sell, right, it may change my plan because you know what? I don't have that much protection here from the resistance trend line. And in actual fact, if momentum is starting to go up, because I know this is a weak resistance trend line, I may be looking to buy and go with the shift in momentum to the top side. Now, one thing that you can do is actually draw both trend lines, right? And leave them there. So you know exactly what level it broke up through. Okay, so if I leave that as red, okay, I can see the price action here, exactly what's going on. It's sort of like still in that barroom brawl. And I've also got the new weak resistance trend line. And below that, I've got support and a weaker support level below that. Okay, so support 1, support 2, and now this is my new resistance line, right? But it's orange because it doesn't have as many touches now, right? It's not close enough to recognize these other trend lines as touches. All right, so hopefully that makes a bit of sense because when you widen out the trend line and you come back to the market, if you're using this specific sort of color coding, you can see exactly what's going on, right? If I just widen it out a touch, I don't need to keep widening it back to where the trend line started. I can see here I've got a long-term support trend line well below the market, right? Down at 108, sort of 75. I've got a trend line here at the moment, which is just being chopped up, right? We're sort of keeping an eye on the price action through that. I've got a support trend line in red below the market and another one in orange, which has less touches, which is not as strong. I've got a resistance trend line at the top, which is weak, right? So, and that just tells me everything I need. Now, I can get rid of that red one if it is making you think that there's something else going on. So then you've got your support and resistance trend lines. Now, this is euro right now. Okay, so if I'm looking at the market, right, and I'm thinking, well, what's euro doing here? Well, I know it's sort of broken higher. Okay, It is starting to trend a little bit to the top side. But this is the thing with hourly charts. They don't give you enough depth and understanding to work out, is euro really going up here or is it just short-term price action? So what we need to do at this point, right, to work out the overall trend is to come back and look at the daily charts. And this will give us a different perspective of euro. Okay, so looking at the euro daily chart, right, and I've already got the trend lines drawn here. Now, this is going to add a lot more explanation to drawing trend lines on the hourly chart. You can see here very specifically the progress of this trend line. From the time it topped out up the top here, this is our starting point. This is our second level. This is when we start drawing the trend line. And then you can start to see where the price action was, okay? Remained below. And then it blasted through that top level. That's at that point, we now adjust our trend line to the new high, right? And then you sort of see what the price action was like after that. Stalling as it got to the trend line. Didn't really get close on this occasion. And then stalled a number of times at the trend line again. And then it has a little poke through the top side once again. Every now and again, it will lose enough momentum just to take out the stop losses on the other side of the trend line. Now, you can start to see here, the trend line is sloping down. So euro is going down. Now, we've got that, so 1, 2, 3 touches here. Everyone's looking to get short euro at this point. And you can see a massive move to the downside. That would be a fundamental drive. Now, as it gets back closer to the trend line, though, the trend line is still valid. The market is looking to sell as it gets closer towards resistance. And once again, but at this occasion, it's lost a bit of downside momentum and we slowly get a grind through the top side here. And we've got a couple of new highs to consider. So all we would do is redraw the trend line. And if I just look at both of those, that looks like the major level, right? So now we've got a trend line with loads of levels on it, right? If we looked at the real history, that was a top. This was another top. That was number 3, 4. You've got number 5. And then you've got number 6. It's stalled there again, right? And so then we're looking at the current market level, right? This is a long-term chart, long-term perspective. So if I widen out my chart to just look at the current market level, right? We've got a resistance trend line with 5 or 6 touches. And where's euro? It's above this level, right? So euro is going up, right? This is where you identify trend lines and trends. Trends will come from the daily charts, but you're doing the same analysis, right? The same way, the same rule of thumb for drawing trend lines. And if you're not sure about the price action around these trend lines, let me just blow this up a little bit for you. Okay, so as it gets close to resistance trend lines, if we are in a downtrend, how do we identify it? It's got at least 3 touches on the trend line and it is sloping down. You come back to this next level, you can see the market is already selling at those levels, right? So this is a daily chart. For almost a week, it actually held the level. But then momentum shifted slightly up, enough to start pushing euro through the top side, okay? Now this resistance level, right, which is here, right? It's offering resistance all the way along the trend line. Once that level breaks, okay, it immediately becomes support. That is a very important thing to understand. So the trend line has been in play for, let's have a look how long. If I just wind back the data, okay, this support trend line goes back to 2008, right? That's how long the trend line is. Euro has been going down. Now, I'm telling you, euro is going up. It's broken the long-term resistance trend line and it's now going up. What do I expect to happen? Well, this is the behavior of trend lines and part of something you need to know. As I said, all along here, it's acting as resistance, right? And we are looking to sell, go with the trend, right? The trend is your friend. Now, when it breaks above this level, this trend line now becomes support all along here, right? Support. They'll be buying on this side of the market, looking for the next big move to the top side, which is where the trend is. So like proper technical analysis sort of theory is a test of the trend line, backs off, breaks through. This is a clean break. You get sideways moving markets. It comes back and retests the trend line and then starts to move to the top side. That's what you're expecting with your price action on a break of a trend line. if the fundamentals are driving the market. And the fundamentals are the key aspect where you can see the trends develop on the daily charts. And that's what we're looking at. Now, if I just come back a touch, right, let's just wind this back. So this goes back to 2008. Now, at the same point, we're looking for the highest level and we're looking for the most relevant low, right? Well, it's not these ones because we've got a low level here. Now, as you've got this massive downtrend, we get the new low and then the next low is a little bit higher, right? So this is the starting point for our support trend line. And you make sure you draw that in there as well. Okay, so you can start to see where that downtrend finished and where it's now starting to trend higher. So when you come back to your daily charts, these are two long-term trend lines. In actual fact, I could draw another one on the downside here over to this point here. And that gives us a bit of extra depth in our analysis, right? Now, this is the really long-term support trend line. So I want to make that green, okay? This is the next relevant support trend line. But this one at the top, it is also a long-term trend line. And I need to make that green, right? For my personal color coding preference. What that means is, right? Say I'm looking at the major currency pairs as a group. Now, if I see an instrument like Euro breaking to the top side and I see that's a green trend line, for me, that's the last long-term resistance level. It automatically triggers me. Okay, I've got to look to get into Euro. I'm a buyer. This thing is going up. It immediately sends you into action, right? I would go back and just check how long the trend line's been in play. I'm like, wow, this goes back to 2008. It's broken higher. The scope of this move is quite large, right? It could go up 10, 20, 30 cents. I mean, it was up at 155 previously. All right, so that's what you need to be doing with the trend lines. It's like your roadmap to the markets. It tells you exactly where the selling is. It tells you exactly where the buying is, right? And just to refresh that, selling is below the resistance trend lines. If you're a buyer, you're buying above the support trend lines. But that changes, right? Because above the resistance trend lines, you've got stop loss orders, right? And that's why the markets rush to the top side when there's a break. Same on the downside. There's stop loss orders. Everyone that's been buying has to sell because it's broken down, right? And that's part of the general price action behavior. So the daily charts, they tell us the big roadmap around what's going on, okay? The hourly charts, these charts are where we're doing our execution. These provide us key support and resistance levels that tell us where to get in and where to get out of the market. And that's the way you need to be looking at it, right? So if I just come back to Euro, right, it's a different story, right? This is a short-term story, a story within the story, right? Short-term charts, they show us exactly what's going on, where the price action is, where the key levels are. Okay, I've got a support trend line here. Yep, I've got a weak resistance line up the top. I know if I'm looking to sell, I know where to sell. You sell towards resistance or on a break of support. If you're a buyer, you're buying closer towards the support level or on a break of resistance, right? Now, if you weren't drawing trend lines, you have got no idea about that. And don't forget, the main thing about these trend lines is all the bankers are drawing these. So you know where the critical levels are, where momentum and direction may shift very quickly. And this is one of the key components that you need to put into your analysis so you're trading with the market. If you're not drawing these support and resistance levels at the correct levels, then who are you following? We're following the major players in the market. So by incorporating this technical analysis structure into your trading system, you'll automatically be trading with the market. And this is a crucial component to you making the right trading decision at the right time, at the right levels. Okay, now once you understand the trend lines, support and resistance, it's now to add an extra probability enhancer, and that's what I would call stochastics, right? Now, stochastics are a real-time momentum gauge, right? And that's something that all the bankers are looking for, trying to assess the momentum in the market. And that's critical because when it gets close to support and resistance levels, that's when momentum can have a big influence on where the next move is. Right now, let's just look at stochastics. If I just widen it up a touch. Now, There's a couple of things to consider here. There's the 80 level and the 20 level. Now, generally speaking, if the momentum is above 80, we consider that to be overbought, right? And when it starts turning down, buying momentum is stalled and now selling is coming into the market, right? On the downside, if momentum is below 20, well, then we would consider it to be oversold. At the same time, you've got the selling pressure, and when it stalls at the bottom and momentum starts to move back through 20, it means there's more buying than selling. And that momentum is gauged from the price action of the major brokers. So it's a tangible thing that you can use to work out whether you should be trading or not, or is your strategy going to work? Now, let me give you an example of how to use stochastics. All right. Now, I've just moved the trend line back to where it was, and it is red, right? We can see it's a validated trend line. It's got loads of touches on it. At this point here, the price action is challenging the resistance level, right? And you might be thinking, oh my God, Euro looks like it's going up. You know, you've checked the daily charts. It has definitely broken higher. Now, the question is, do we get into a trade here, go long and buy Euro, right? That's what we're trying to work out. That's where we can use stochastics to help you make that decision. Now, at the time it is breaking through this level, stochastics is getting into an overbought situation, right? To me, that may mean that this move is short term. Okay. Is this driven by a real fundamental, or is it just an overshoot of momentum to the top side, right? It is overbought. And then when you see momentum stall, that really coincides with the top of the Euro move, right? And then quickly selling comes back into the market and Euro drops down. So if you were looking to buy here, as I said, you would consider stochastics and go, you know what? It's too overbought for me. It's not the right time to be getting into the trade. Whereas on the opposite side of things, say for example, it was breaking through that level and we were in an oversold situation right down here and it was coming back up with an upward bias in momentum. Well, that's when you would get into the trade, right? It's one of those last pieces of the puzzle that you would consider to help you improve your probability of success, right? And if you go back over the course of time, you'll notice when you see really big overshoots of momentum, right? And these coincide with lows, right? It's no surprise. But what we're trying to do to improve our performance, not just looking at momentum as the core instigator, but also including our technical analysis, our support and resistance trend lines, right? Because there's two components here. There's the order structure from within the banks at these levels, which I've already explained. Then you overlay momentum in the market to work out whether you should be buying or whether you should not. Okay, what that's going to do for you, it's going to change your overall performance very quickly. No longer will you be getting into false breaks, right? You're thinking this is moving up, but it just craps out to the downside. That's what we would call a false break. And you can see that just by incorporating stochastics into your decision-making process. Now, if you haven't been using trend lines, then you've probably been using moving averages to try and work out where those key levels are. But you know what? The markets are very dynamic. So you can get caught up with using too many moving averages and trying to work out where that key entry level is, where the direction's coming from. There's too many things to come into play. But what we do is we use a specific bull bear pivot line or moving average for our hourly charts to tell us basically, is it currency going up or down? And the same for the daily charts. We use a different time frame. Now, let me just give you a quick run through that, right? I don't use it as a core entry facility. It is more to tell me, you know what, is the currency going up at this point or going down? It's like a last probability enhancer to potentially give you the edge in the market on that trading opportunity, right? So the bull bear pivot line here on the hourly charts, I've got it set at 70 hours. So it's more of a visual to tell me if an instrument is going up or down. In this situation, Euro on the hourly charts, at this point here, it's above the bull bear pivot line. So to me, it's going up, right? If it goes below that bull bear pivot line, to me, it's now going down, right? This is a bit more relevant when you come to our live trade signals, okay? Now let's go to the daily charts and have a look at that picture. Okay. Now the bull bear pivot line on our daily charts is 200 days, right? Now you can see exactly how it works, right? And it does come into play quite nicely. Now, once again, it just confirms to us if euro is going up or if it's going down. Now, if the price is below the bull bear pivot line, to me, the trend is down, right? If it's above the bull bear pivot line, it's going up. That's how easy it is to work out. Now, it's not rocket science and it's not the core trade decision process, but it does behave extremely well. Now, this is sideways moving markets with difficult fundamental price action, right? A lot of weird economics coming out and you don't see clear direction. But once the fundamentals do come into play, you do see clear direction. Okay. Now, I have seen traders use the technical trading strategies around the bull bear pivot line, especially on the daily charts. And you can see how well the price action is, right? This one here breaking down, breaks back up, and then straight back down. And also, as it came from the bottom, broke up through the bull bear pivot line, retested perfectly, and then snap to the top side. Now, trend lines are by far and away a better tool for working out where the order flow is. But the bull bear pivot line, if you are sort of starting to work out, you're not sure if it's going up or down, maybe that's something you could incorporate. And when you get up our live trade signals on our website, this is going to make a bit more sense because you can see where the bull bear pivot line comes into the decision-making process. Right? And we're now starting to build a bit more structure around our trade selection, right? You've got the bull bear pivot line telling you it's going up. You've got the trend line here showing you exactly where the order flow is, right? A lot of stop loss orders, buy orders above the trend line. And you've also starting to see where momentum can come into play, right? So by now you should start to get a bit more feel of technical analysis, right? There's a lot of structure. There's a number of key components. You need to know which ones are more important than others and which ones are probability enhancers. And that's going to help your whole trading system. Okay, now let me explain Fibonacci retracements. Now, back in the day in the banks, we basically used Fibonacci retracements to identify key levels when an instrument moved through trend lines and we had no trend lines in place. Now, I know a lot of traders use Fibonacci's on short-term charts and in everyday price action, but I don't really use it that way, right? I was trained a specific way to use them when we didn't have trend lines. They do provide tangible levels if there are no trend lines available, right? And so in this example here, euro has broken higher. Now, the previous highs can act as sort of resistance levels, right? Levels where the market will pause. But outside of that, right, we're looking to the Fibonacci. Okay, so all I need to do is click on Fibonacci retracement, come up to the highest point where the down move started. Okay, make sure you're on the highest point. I'll have to come back and correct that level. And then just find the lowest point, right? So if I just blow that up, I want to make sure I'm on the absolute high. And then I can see exactly the levels. Now, I've got a very good visual here on Metastock, right? You can see exactly where the levels are. Now, once I've got the Fibonacci's there, right, there's no resistance trend lines. As I said, some of these previous highs can come into play. But I do have some tangible levels here. And you can see where they are over here. 120.19 is the 38.2. The 50% at 127.86. The 61.8 at 135.53 and so on. So you've got a roadmap as to where the euro could potentially go. Right? And this is a good thing to actually include on your charts, even if you're not looking to sell at those levels, right? Because you might be sitting here thinking, well, euro's broken to the top side. Where can it really go? Well, these are the levels where it's most likely to go and stop. Okay? Doesn't mean it turns around the other way, but it may pause at those levels. So if you do go long, right, you may be looking to take profit just below the Fibonacci's. Okay, they give us structure like the trend lines when we don't have any other trend lines in play, right? That's the way we were trained at the banks to work this. Now, as I said, I know a lot of traders use this on their hourly charts. It's too much information for me. But at the same time, if we didn't have trend lines on our hourly charts, well, then you could come back and use Fibonacci retracements, right? Once again, this isn't really about, getting into the market. It's about understanding where the market is going and how to manage your positions around that. Okay. They could well be a level where you get into the market, right? If it does break up through the next Fibonacci level, right? That could be something you could be looking at. Obviously, trying to incorporate momentum and any other probability enhancers that you could find at the same time. So Fibonacci retracements, it's something to consider and will add a bit more depth to your overall trading system. Okay, now if you're trading the yen and the yen crosses, then you really need to consider the Ichimoku Kinko Hyo cloud, right? It's a bit of a mouthful, but believe me, it is one of the best trading systems globally. Now, Japan is the biggest Forex trading country in the world. They use a simplistic model. And on this chart, there's a whole range of different things. But what they don't use is trend lines. They don't use a bull bear pivot line. They use this cloud formation, right? And this is the Ichimoku cloud. It is a giant moving average. And that's all you really need to know. Now, it behaves exactly the same way as support and resistance trend lines. Now, let me just blow the screen up a bit. Okay, so when the market is below the cloud, the bottom of the cloud acts as resistance and the top of the cloud acts as a secondary level of resistance. So you got resistance 1 and resistance 2, right? If the price is above the cloud, the top of the cloud is support level 1 and the bottom of the cloud is support level 2. Simple, right? Simple logic. Now, the great thing about this is it's an automated moving average. So it's automatically applied to every chart. So every Japanese trader enters the market or closes out at the same time. This is why it's a perfect system. Unlike trend lines, which are largely subjective, this is an objective moving average that just works, right? And it works because the entire Japanese market, as I said, the biggest Forex trading market in the world, uses it. So we can use this to our advantage, right? If you see momentum going up, there's trades you can place on here. Now, if the price action is below the cloud, you might be looking to get short and play the range, right? The range below the market. If you start to see momentum shift and it's going back up, that might be enough to break through the first level of resistance, right? And you're placing a break trade. Now, to me, the area inside the cloud, this is the barroom brawl, the uncertain trade zone, right? Where is it going from here? Now, sometimes it can break through, stall, hit the top, go straight back down. At the same time, you've got 2 resistance levels. So you get 2 bites of the cherry. Like if it's coming from the bottom and it breaks through the top of the cloud, it's a clean out, right? Stop losses are triggered. The same when it's above the market. Hits the first level of the cloud, it holds. And then when it breaks, there's a flush out of the market. Now, if you know how support and resistance trend lines work, you're going to know how the Ichimoku cloud works, right? It's genius because you don't need to do any extra calculations. You're just looking at momentum in the market, looking where the cloud is, and placing your orders around that. Now, I developed a trade tool called the Ichimoku Cloud Trader to take advantage of trading the yen and the yen crosses specifically off the cloud because it's such a good structure. Now, that's the starting point. Let me just sort of bring back into scope trend lines. Now, the Japanese traders don't use trend lines, but we can use our extra resources and our extra knowledge of trend lines, which the Western world uses, and incorporate that with the Ichimoku cloud. Now you've got real structure for trading the yen, okay? You can see very clearly on this structure here, that red resistance line is showing us exactly where dollar yen is going, right? And if I just zoom in here, there's an actual structure here where the resistance trend line and the bottom of the cloud are sort of almost coalescing. Now, this is what I call the Ichiban strategy, right? Selling when you've got a resistance trend line, you've got resistance from the cloud just above that, and it's 9 times out of 10 a winning trade, okay? But we can take it a step further, include long-term trend lines, exactly the same way as we do on all the other pairs. You can see where the key levels are, right? You end up with major trend lines to show you where to get in, where to get out, and how to structure the trading opportunities. The Ichimoku Kinko Hyo cloud is such a good indicator. I wish the rest of the world used it, right? We wouldn't have to draw trend lines and everyone would know where to get in and where to get out. So if you are trading the yen and the yen crosses, this is something that is 100% essential that you put on your charts. Now, you don't need to do all the extra trend lines, right? To me, they are probability enhancers. But what you need to do, you need to have the cloud, you need to know where the key levels are and what happens at those levels, right? Once again, if the market's below the cloud, you've got two resistance levels. If the price is above the cloud, you've got two support levels, right? And that's basically it. And when it breaks back down through the bottom or the top of the cloud, I tell you what, there's usually a flush out and there's cash in those moves, right? And don't forget, dollar yen, it is the greatest trending instrument out of all Forex pairs, right? The beast, when it gets going, it can deliver huge dividends. But just understand, it is called the beast for a reason. It's pretty wild. So make sure you've got structure around your entry and your trade plan before you start jumping in to the yen and the yen crosses. Okay, now let me show you how to overlay other instruments on your charts. Now, this is really important if you're trying to look at different correlating pairs, whether they're positive or negatively correlated. You can see if there's a match. Sometimes that can be the lead-in that you need to get into the trade. Now, a very good example of this is the Canadian dollar, right? It's got the closest connection to a commodity than any other currency, right? And I'm talking about oil, right? Oil is a big driver of Canadian dollar value. Now, why do I want to overlay oil on dollar CAD? Well, because oil generally tells us where the Canadian dollar is going, right? So it's very important if you want to get the edge and you see oil move, well, you can get onto a dollar CAD trade straight away. Now, to do so, I just come up here to compare. I just type in the code for oil, and then I've got oil on my charts, right? Now, the most important thing to understand here is on the y-axis, okay, this is the value of oil going up, right? But the problem is the Canadian dollar against the US is quoted the US against the Canadian dollar. So it's the second part of the quote. And because of that, we need to invert the y-axis to give us the true reflection of what's going to happen to the Canadian dollar if oil moves and vice versa. Okay, so I simply click on the chart, invert scale, and now we can start to see exactly what oil is doing and when it is starting to correlate with dollar CAD, right? So when oil falls, right, don't forget this is going up is going down for the price. Dollar CAD should go up, right? That's the general relationship. So you'll be able to see when that correlation is very strong and when it's very weak, right? Simply by scrolling back, you can see over the course of time where dollar CAD and oil have a close relationship, right? It's almost in step. And when it is correlating, that could be the time to start trading. Now, of course, if there's a separate event, right, and oil is definitely impacted by OPEC, and if they make some outrageous decisions, then you'll see that correlation break down. Okay, at that time, you know not to trade dollar CAD with the oil price. So this is really going to give you an extra layer of dimension around what's going on with oil and the Canadian dollar. Now, this is the same for a lot of equity indices and some currency pairs. And when you understand where those natural correlations are, most of them are with the commodities, Aussie dollar and gold or copper, then you can simply keep an eye on the commodities. And if you see a price move, well, then you can jump on one of the currency instruments, right? This is a little bit more advanced, but something I thought I'd put in at the end to give you that extra layer of knowledge. Okay, now we've gone through a lot of components of technical analysis. Now let's bring these things together to show you the ideal setup, right? Now I'm on Aussie Kiwi. Now the ideal setup is short-term price action is down. The long-term trend is down. Long-term momentum is overbought and going down. Short-term momentum is going down. It's below the bull bear pivot line on the hourlies, and it's below the bull bear pivot line on the dailies. And at this point, you've got every technical aspect in your favor. On the short-term charts, the price action is stalled and is now going down. Long-term, it's going down. Momentum is going down short-term. It's just starting to go down on the long-term chart. This setup is perfect. And to achieve this, you just need to understand the trend lines. Okay, resistance trend lines on the top, support trend lines on the bottom. Understand what the bull bear pivot line is. It's just a way to quantify if an instrument is going up or down. We've got our stochastics, which tell us where general momentum is. And technically, that's all you need, right? So each day we're coming back to the markets and just checking our hourly charts to see what's going on and then making the small adjustments as we need to, right? Euro's broken back down. So I'll adjust that trend line to the top. So I know exactly where the key level is from here. And I could do this across the board, and this will keep you in check. Now, the longer term trends on the daily charts, you don't need to adjust those charts every day, maybe once a week, just check them out. But make sure you go through your charts and you find these key levels. It's going to go a long way to identifying where the next best trading opportunity is. And it's something very simple that you can incorporate into your daily trade routine. Okay. When you've drawn the trend lines, just quantify them. Okay. Dollar yen was going up, right? We did have the start of a short-term resistance trend line. We've got the cloud behind us. And then you can sort of start to work out whether you should be getting short or long. And don't forget, we have got a huge amount of trading instruments to look at, okay? So focus on your favorite pairs, the instruments that you do have an affiliation with, okay? Usually it's where you're located, right? If you're in the UK, you're looking at sterling. If you're in mainland Europe, you're looking at euro, okay? If you're in Australasia, Aussie and Kiwi, and the yen. If you're in the US, well, you're looking at all the major pairs because the dollar is the benchmark currency for most trading instruments. Okay, so I hope this presentation helps you understand how the bankers do their technical analysis. You can easily incorporate all these components into your charts and into your trading system. And this could have an immediate impact on your overall performance. Don't overthink it. Draw the trend lines and then start doing some analysis. It's as simple as that. If you have any questions, just add a comment below and we'll get back to you as soon as we can. All right, guys, I want you to be more successful. And believe me, this will have you trading with the market and not against it before you know it. Good luck and happy trading.